You opened a checking account, they didn't charge you a dime, and you walked away feeling like you got something for free. You didn't. Right now, while you read this, your bank is quietly earning money off the cash sitting in your account. Let me show you exactly how. Banks are some of the most profitable businesses on earth, and a huge chunk of that profit comes from regular people like you. Here's the thing. Almost nobody ever explains how the machine works, so let's open it up and look inside, gear by gear. Start with the biggest myth of all. The idea that your money just sits safely in a vault waiting for you to come get it? It doesn't. The moment your paycheck lands, the bank lends most of it back out to someone else. Banks are legally required to keep only a small slice of deposits on hand. The rest is free for them to put to work. So your savings become someone else's car loan, someone else's mortgage, someone else's credit card balance. And here's the core of the whole business. They pay you almost nothing to borrow your money, then charge a lot to lend it. That gap has a name. It's called net interest margin, and it is the single biggest way banks make money. Picture it simply. The bank borrows your dollar at 1%, then lends that same dollar at 7%. That 6-point spread is pure profit on money that was never even theirs to begin with. Now multiply that across trillions of dollars in deposits. Suddenly, a tiny gap turns into staggering amounts of money. In recent years, U.S. banks earned well over $600 billion in net interest income in a single year. Every cent of that started as ordinary deposits. Your rent money, your emergency fund, your paycheck, all quietly working for them. Let's make that gap real. A typical big bank savings account pays you a rate so low it rounds to nothing. Meanwhile, the loans they hand out can charge 7, 10, even 20+% on a credit card. Same institution, same vault. They just stand in the middle and collect the difference day after day. And lending out your deposits is only the first floor of this building. There are several more profit floors above it. The next floor is fees. And fees are where banks get genuinely creative with your money. Monthly maintenance fees, minimum balance fees, ATM fees, wire fees, paper statement fees. Each one looks small on its own. But small numbers times millions of customers add up to one of the most reliable profit streams in all of banking. American consumers pay billions in account maintenance and ATM fees every single year just to access their own money. Then there is the most painful fee of them all, the one that hits hardest exactly when you can least afford it. Overdraft. You spend a few dollars more than you have and the bank charges you a flat penalty for the privilege. A typical overdraft fee runs around $35. Buy a $5 coffee while overdrawn, and it can cost you $40. For years, some banks even reordered your transactions, largest first, to trigger more overdrafts in a single day. Overdraft and related fees have pulled in billions a year, and they fall hardest on the people with the least cushion. The good news, rules and competition have started shrinking these fees, but many still exist, quietly, in your account terms. Now climb to the next floor. This one earns money every single time you tap your card, and you never even feel it. It's called interchange. Every card swipe sends a small fee from the store back to your bank. That fee is usually somewhere around 1 to 3% of the purchase, paid by the merchant on every sale. You think the store eats it, but the store bills that cost into its prices. So in the end, it quietly loops back to you. This is why your bank loves giving you rewards and cash back. They share a sliver of the swipe fee to keep you spending. Card networks and banks split tens of billions in swipe fees each year, all riding invisibly on top of everyday purchases. So step back and look at the full machine. Your deposits get lent out, your fees stack up, your swipes pay them too. And the foundation under all of it is that one stubborn gap. They pay savers almost nothing while charging borrowers plenty. Here's the part that stings. When central banks raised rates, loan rates shot up fast, savings rates barely budged. That delay alone earned banks a fortune. The wider the gap, the fatter the margin sitting on your money. So who actually pays for all of this? Not the wealthy with their high-yield accounts and negotiated rates. It's the everyday saver, sitting in a near-zero account, hit by fees, paying interchange, never told there was a better option. But here is the empowering part. Almost every one of these leaks has a simple, legal patch. Let's stop them one by one. Leak 1. Move your savings to a high-yield account. Many online banks pay far more than the big bank near-zero rate. On $10,000, that one move can mean hundreds of extra dollars a year, just for parking your money smarter. Leak 2. Kill the fees. Pick a checking account with no monthly fee, use in-network ATMs, and turn off overdraft coverage. Leak 3. Set a low balance alert. A simple phone notification can save you a $35 overdraft every time. Leak 4. Let the rewards work for you. Use a no-fee cashback card, pay it off in full, and keep that interchange sliver. None of this makes banks the villain. They are just a business, doing exactly what the rules let them do. The only real mistake is not knowing how the machine works, because once you see it, you stop feeding it for free. That is exactly what we do here. We hand you the cheat sheet to the money machine. This is Brainonomics,